Hi, my name is Tim Jones.
I'm James Kirby.
And I'm Cody Edwards.
Today we're going to be talking about Papa John's stock. Apologies for the board. You might not be able to see it, but we're going to tell you why you should buy Papa John's stock.
All right, just a quick company outlook. Papa John's is a respected competitor within the restaurant sector, and they specialize in fast food pizza delivery chain. From the past 13 out of 15 years, they have been ranked number one in customer satisfaction by the American Consumer Satisfaction Index. That is a heavy-hitting statistic. That means that over all of the competitors worldwide, they have been number one for 13 out of 15 years. It's very important and looking forward to their growth. They've also met the benchmark set by their own company and by analysts throughout the world. So as an example, in quarter two of this year, 2014, they projected that they would beat their overall standings from last quarter. They've in fact done that, with revenues exceeding 9.1% than quarter two of 2013. Also, their quarterly dividend has jumped between quarter one and quarter two of 2014 by 12%, going from 50 cents to 56 cents.
Just some investment risks associated with Papa John's. The most prominent one is being the cost of cheese. Cheese alone is over 35% of their cost of sales. Last year, the cost of cheese went up $1 per block, which hampered away at their net income, but at the same time, there was still positive revenue, and Papa John's still outperformed the industry. Kind of going along with the supply cost of sales, they only have one supplier, which is obviously risky for, it's very risky since one supplier, if that supplier is hurt financially, Papa John's will therefore be hurt. They also have a fragmented market. The fast food pizza chain restaurant is all fragmented. Papa John's is not the industry leader, and they're really a price taker since the industry is so saturated. And lastly, they're expanding globally, so that expansion comes along with all the risks of other countries and whatnot.
All right, and then I'll look at some key financial ratios here. You can tell between 2014 year to date, it's the second quarter, and going back to 2013, current ratio, they have maintained about the same level for their current ratio, showing that they can adequately cover their current liabilities with the current assets on hand. Going down the list, you'll see total asset turnover. While it is not at the 3.2 level set in 2013, as of right now, they are above what they did for 2013's January through June 2013 numbers. So they're on the right path into reaching the numbers set by 2013's overall, which is a good indicator. You'll see similar results going through the rest of the ratios, and I would like to pinpoint a little bit of a DuPont analysis. You can see that for 2014 and 2013, they are on track also into improving on their overall return on equity. You can see that while their equity multiplier seems a bit high, this will eventually level out during the year because, as you can see also, the 2013 ROE for this two-quarter period was also very high, and then it balances out towards the end of the year. So overall, showing some very good numbers going forward.
Okay, so next we decided to take a look at the P/E ratio of Papa John's compared to three of its competitors in the restaurant industry. And for its key competitors, we decided to take a look at Domino's Pizza, Jack in the Box, and Yum Brands. We decided to choose these three companies because even though they're all in the same industry, they are all a little different than each other compared to Papa John's. So Domino's Pizza is a similar to Papa John's. It's a fast food pizza company, whereas Jack in the Box, while it's also a fast food company, it specializes more in hamburgers. And we decided to include Yum Brands because even though they actually own and operate different restaurant chains such as Taco Bell and KFC, we thought it would be important to take a look at the P/E ratio for that because it's also in the same restaurant industry. So next we charted out the P/E ratio for the past 5 months for the four companies. And as you can see, for the last 12 months, Papa John's has a lower P/E ratio than its competitors at 23.8. And if you take a look throughout the past 5 years, you can tell that it has had one of the lower P ratios compared to its competitors, which means that it is a more valued stock than a growth stock. And then next we took a look at the forecasted P ratio for the next 12 months. And if you take a look here, you can see that Papa John's has a forecasted P ratio of 19.5, which again is the lowest, which is lower than Domino's and Jack in the Box. And so for the next, we used the forecasted P ratio and the contemporaneous earnings per share, and we multiplied the two to find the value of Papa John's stock. And so we took the 19.5 and multiplied it by $2.03 of earnings per share, and that brought us out to $39.58 as a value for Papa John's stock, which is in fact higher than its current price of $37.73, therefore making Papa John's a undervalued stock.
Next, we did a discounted free cash flow model. The model is slightly modified because we struggled with determining weighted average cost of capital and growth. So we kind of did an adjusted one where we found enterprise value through FactSet. We got that value, subtracted debt from that value, so we would get just the value for equity holders, and we divide that by shares outstanding. If you can see the math, we essentially did that out, and we got an intrinsic value of $38.19, which is also above the market price, which would identify Papa John's as a buying opportunity. Overall recommendation is a buy. Papa John's, as you can see, is very